And the question that underpins all of this here is that you're at a market where so many investors had so much exuberance in the bond market and the equity market. For those who are a little worried about what could lie ahead, if all of this exuberance doesn't work out, how do you make sure you're protected at this point?
Yeah, I mean, there's a myriad of risks that could derail us this year, from policy changes after key elections, and we have a lot of elections coming up, to geopolitical conflict, to sudden changes in key commodity prices. Plus, of course, just looking at the domestic economy, can we get the combination of factors that would allow the Fed to actually cut 150 basis points this year without seeing job losses? I mean, as Austin Goolsbee put it from the Chicago Fed late last year, it's basically never happened. So lots of risks to think about hedging. I think you start with the biggest one, which is, do we get a soft landing or not? If we get a soft landing, I still think there's a question about the Fed cutting 150 basis points. So I think you want to hedge that. You want to hedge the risk that rates are higher for longer than what's discounted, which means a headwind for equities at the margin and some risks out there lingering about what higher rates mean for things like refinancing. We have $117 billion of office commercial real estate that will need to be refinanced or retired this year. That's a big number, and if rates stay higher for longer, that's a bigger risk. So the rates risk is out there. I think the economic risk is out there. What if we don't get a soft landing? What if it's a harder landing, more job cuts, consumer that doesn't soften but really falls? So that's one where you want to be treasuries, keep some of that cash. Geopolitical risk, I think gold still plays a role there. So we're back to 60-40, and then some other additional factors that'll help you give diversification at the margin, whether that's through alternatives or gold.
Rebecca, what do we get no landing? What happens if the U.S. economy actually takes off? Financial conditions have loosened significantly. The labor market is still strong. Why can't this economy actually go from strength, which it in some ways delivered last year, to strength?
I think the challenge with the no landing is that the service sector would stay very strong in that scenario, which means service sector wages would stay strong. And that means the Fed can't cut interest rates nearly as much as priced in. So in that environment, you want to be hedging rates staying higher for longer. But to your point, if we have no landing and the consumer stays strong, you're going to have a lift for earnings. People are going to continue spending. And so the equity market will do well from that point of view, revenues, but they won't do well from the borrowing costs. So you just want to think about what kind of stocks you own in that environment.